Capital Gains Tax Solutions podcast, also stream on Expert CRE Secrets podcast, where we believe most high net worth individuals and those who help them, they struggle with clarifying their capital gains tax deferral options. Not having a clear plan is the enemy, and using a proven tax deferral strategy such as the deferred sales trust is an amazing way for you to exit highly appreciated assets, eliminate the need for the 1031 exchange, defer millions of dollars of capital gains tax, and get timing back on your side so you can create and preserve more wealth or help your clients, investors, or family do the same. My name is Brett Swartz, and I'll be the host today for the show. And I'm excited because each and every episode, I get to bring on some of the best real estate, financial, wealth, and business minds in the world, where they share their ideas, deal stories, and inspiration. So together we can make complex tax deferral strategies simple and passive income plans achievable. I'm excited about our next guest. He is a resident of North Carolina, and he serves as a managing partner for Cash Flow Champs. He's responsible for building and maintaining broker relationships and performing and overseeing the company's underwriting activities. He's involved with contract negotiation, capital raising, and just really helping deals to close. He's a general partner in over seven multifamily properties, totaling over 700 units, and having gone full cycle with 4 multifamily properties, 15 years of experience in commercial real estate investor in a new NYC, New York City, and so much more. Please welcome to the show with me, Charles Seaman. Charles, how are you doing?
Brett, thanks for having me. Pleasure to be here, and I'm doing great today.
Absolutely. And for our listeners getting to know you for the first time, would you give us a little bit more about your story and your current focus?
Yes, absolutely. So I probably had a little bit of a different path than most who enter in this business. It wasn't something that I had a burning desire initially to get into commercial real estate, but it was more so that I was, as I like to tell people, young, dumb, and broke. I was 20 years old and I needed a job, and I wound up working for a gentleman that was, amongst other things, a commercial real estate investor. And during my tenure with him over 14 years, I was fortunate to work very closely with that individual, and I learned a lot from him. So it was during that time that I sparked an interest for commercial real estate, and that ultimately led to me eventually going my own way and going the syndication route, which is what I'm focusing on now. So for the last 5 years, I've been focusing full-time on multifamily syndication throughout the Southeast. And we really focus in the Carolinas, Georgia, Florida, with primary focus on value-add properties.
Fantastic, Charles. I love that. And before we dive into the show at hand, which is building a multifamily cash flow, I do want to take one other step back. I believe we've all been given certain gifts in this life, and these gifts have been given to us and be blessing to help to others. So I'm curious, what do you feel like your one or two superpowers or gifts that you believe you were given, and how does that help how you help and bless people today?
Yeah, absolutely. So great question. So my greatest gift, without question, is my ability to deal with people. And while it's not something you're necessarily going to put on a resume or something that you're going to brag about as an achievement, what I found is it's a skill that serves me very well and has allowed me to produce most of the success that I've achieved. Specifically in the real estate niche, one thing that I do very well is find deals. And a lot of that really comes back to my ability to deal with people. And the way that I really help people is with underwriting. Every Saturday, I host a free underwriting session where I open it up to people who are interested in learning about underwriting multifamily deals. And we do that every single Saturday with a different deal that we go through.
Fantastic. That makes sense. Go with people. It helps you find more deals, and then helping more people to find deals probably helps you find more deals. It's kind of a good momentum in there. So let's dive right into the topic at hand, which is building multifamily cash flow. So Charles, what's the number one secret to doing just that?
Buying right. If you buy wrong, it's going to be very tough to correct afterward. 2 things I would tell you, 2 secrets: buying right, financing right. If you do either one of those things wrong, it's going to be very challenging for you.
And, I couldn't agree with you more. I call that matching cash flow with debt flow. Mm-hmm. Right? Most people are so focused on cash flow, and cash flow technically is associated. It's debt flow because you got after debt service, right?
Right.
But more than that, it's underwriting in the pro forma of what could happen with the debt. And this is part of why we're in this challenge that we're in right now. So walk us through perhaps, for the deals that you've done and how you're underwriting. Were you able to kind of anticipate what, no one really could anticipate how fast it went up, but what were you doing to protect, investors for the debt flow scenario to make sure you're locking in for longer rates? Yeah,
good question. So with most of our underwriting, I like to think we're conservative with a lot of our assumptions, but to your point, we were no different in the sense that we certainly didn't anticipate how fast interest rates would rise. So, the things that we generally do is, one, we like to be a little more conservative on some of our rent bumps. If we see a clear difference between the subject property that we're looking at and the comps in the area. And we believe that there's a way to go out there and to close that gap. We will usually underwrite for that most times over a 2 to 3 year period. One thing I think that's been very common the last couple of years for a lot of people who are just starting out, they probably looked at some of the year-over-year rent gains that you saw in 2020 and 2021, and maybe they were underwriting to those as if they were normal. Now, what I would say to anybody here, especially if you're on the newer side, you should never be underwriting a 15 to 20% gain for a multifamily property. While that's a very nice thing that happened for property owners in 2020 and 2021, it is certainly not a historical norm. So most of our underwritings outside of a value add bump is probably going to be 3% annually. And that's a more historical norm, something that we've seen, many times throughout the past. Another thing is your terminal cap rates. 2 years ago, a lot of deals were trading at cap rates in the 3% range, which looking back on it now, I think a lot of us look at it and say, well, it certainly couldn't have continued forever, and it obviously didn't. So you always want to be more conservative with your terminal cap rate, and you want to make sure that you're predicting, you want to be focusing on cap rates decompressing versus compressing. Look at them as compressing as a bonus, but not something that you want to be relying on for your deal to work.
Yeah, making some sense. By the way, you can learn more about Charles Seaman by going to cashflowchamps.com, cashflowchamps.com. Yeah, I couldn't agree with you more on that. I think things got a bit out of hand on the run up of 19, 20, 21, and then kind of the music has stopped. And now we're seeing those that haven't fixed debt in a way that these bad debt now is poisoning typically pretty good operations. But to your point, the rent projections, right? And these terminal cap rates, gosh, you have to be pretty optimistic. Talk to me about the deals that you did buy. How are you feeling about the ones you've bought, right? How many deals did you say no to because the numbers just didn't make sense? And perhaps the patience it takes to say no versus, not doing the deal.
Yeah, great questions. So what I would say is you're always going to say no a lot more than you say yes in this business. So keep that in mind for anybody out there, whether you're new or experienced. I'm sure you could probably attest to that. So in any given year, we're passing on hundreds of deals for different reasons. Sometimes they just don't fit our buy box. Sometimes they're not priced to the number that we would buy them at. And sometimes there's other factors. Maybe we just have deals going on and we don't want too many at once. So you're always going to say no a lot more than you say yes. What I would say, for any of my deals personally that I'm involved in, it really comes down to the debt. So the deals that we have long-term fixed rate debt on, those deals are generally doing fine. The deals that we have floating rate, short-term debt, not as fine. And what I say with those, unfortunately with the ones we have short-term floating rate debt on, we did buy those properties when interest rates were substantially lower. And like many other operators that are out there at this point, there's struggles with them. So there are cash flow issues because even in cases where you're able to increase the rents, the problem is you really haven't been able to keep up with where the interest rates have went, and also with where insurance premiums are in many markets because they've been running rampant for the last 16, 17 months.
Yeah, I couldn't agree with you more. It's interesting to see what's going to happen. I think 2024 will be the best buying opportunity for real estate, probably more the second half of 2024. But we're seeing opportunities. We're seeing more and more capital calls. We're seeing having a cash infusion into these deals. How are you seeing the timing of distress right now for multifamily, and anything that you're like, you tied up that looks really good and you're getting a discount on?
Great questions. I would say a few things. So just to throw a few quick statistics at people. So last week I was reading an article and it said there was something like $929 billion with a B dollars of commercial real estate mortgages maturing this year. Now, out of that, $270 billion were maturities that were supposed to happen in 2023, but due to lender workouts or extensions, they were able to buy some time and essentially push them into this year. On a personal note, I do think that there are going to be a lot of buying opportunities, but I think it's going to take a lot longer than most people are thinking, probably than I had thought initially too. I see a lot of them getting pushed back to after the election in November. And I don't think it's going to be beneficial for either party or either candidate to have a whole bunch of commercial real estate loans failing, which could potentially lead to bank runs before the election. So I do think you'll see a lot of lenders, work things out with borrowers until after that happens, and probably really initiate one next year even. But I agree with you, Brett. I think there's going to be a lot of great buying opportunities. I think there's going to be a lot of deals that are failing. There was another report that I was reading this morning from Newmark, and Newmark's a well-established, well-positioned firm in the commercial real estate space. With their report, they showed that there was 62% of loan maturities in the multifamily space that could be in trouble. That's a staggering amount. Now, it doesn't mean that 62% of those loans are going to result in failures. Some of them will get worked out. Some of them will refinance. Others may just wind up selling and getting enough to satisfy the mortgages. But at 62% that are troubled, even if half or even if a quarter of those fail, you have a staggering amount of opportunities on the buy side. So we did buy 2 properties last year. Both of them had great Fannie Mae loan assumptions with interest rates in the mid threes. They both had plenty of time left on the loan maturity, so that's what made us feel confident in those. But right now, with anything we're looking at, I'm being very cautious because I am expecting property values to drop considerably more from where they are now. And I think that, especially if you're going in there with new financing, you need to be buying at prices that are going to make sense. And I think we're still in a period of price discovery where those prices haven't really, they haven't come to market yet. So it may be a few months or even years before we really have those answers and can make confident buying decisions with them.
Yeah, I couldn't agree with you more. And I think it's fascinating. You bring up the election. I think it makes sense, right? That with everything that's going on there, it's a big year for a lot of things, and commercial real estate will be one of them as well. So I want to connect this idea, right? I think some of the challenges for folks that are, on the run up is this thing called the 1031 exchange, right? Mm-hmm. Where you have you get people doing deals, and moving large amount of money that have a lot of pent up gain, which puts a lot of pressure to doing the next deal, which drives up prices sometimes, right? That's part of it, right? Also, you have newer groups that are coming in and they're wanting to get their first deal, right? Or get going, right? They don't want to miss out, right? Right. And so they're marketing really well. They don't necessarily have the operational experience, or they don't necessarily have the track record, but they're trying to break into the industry, and they got to start somewhere. And then all of a sudden, if they can't sell at the right time, it's tough. But I'm just curious, what are you seeing the biggest frustration with the 1031 exchange as it pertains to capital gains tax? Because to me, it's all about timing, right? Timing of knowing when to sell, when to be out of debt, when to sell and when to wait on the sidelines. However, capital gains tax is a big part of this. You being from New York, I'm originally from California. I'm now in Florida, right? Some of the 2 biggest tax states are New York and California. And it's 25 to 50% of the gain gets wiped out with depreciation recapture and capital gains tax, unless you have a strategy. And that tends to be, if you sell high, you're buying maybe higher. So, but what's your familiarity with 1031? What's the biggest frustration that you've seen?
Sure. So I'm familiar with the general concept. Admittedly, I've never done it myself, but I have partnered with an individual who's done one into one of our deals for a tick structure. My general premise with the 1031 strategy is that I think it's effective if you're holding the property for the long term. And that's not a bad strategy. So let me be clear. For anybody listening out there, some people make it sound less sexy to hold a piece of real estate for a long period of time. I would tell you, I think that's actually a good thing, and it's probably something that a lot of us don't do enough of. When you're investing in real estate for a 3 to 5 year hold period, there is a lot of risk with market timing. And when I listen to people say, "Oh, it doesn't matter when you buy," well, that's true if you're going to hold it for 30 years. It's not as true if you're going to hold for 3 to 5 years, because if you buy at the top of the market and that's your hold period, the market cycle is going to be very unforgiving because it takes time for things to play out. So with the strategy, I think it can be a very effective strategy. I personally, am very nervous about where tax rates are heading in the future. I don't think they're going to be going down. So the idea of deferring tax doesn't necessarily excite me as much as finding a way to mitigate or eliminate it. But if the intent is a long-term hold, I think 1031s can be very effective.
Yeah, I could agree with you more. And by the way, we can learn more about Mr. Charles Seaman by going to cashflowchamps.com, cashflowchamps.com. Yeah, I agree with you on the frustrations with or the assessment of the 1031 exchange. I think a part of it too, where people missed, is we took debt for granted for so long. And one of the challenges with the 1031, Charles, you must replace equal or greater debt on the next deal, right? It's not just
Right.
value. So you're selling for 10 million. If you have 4 million of debt, well, that next deal has to be 10 million or greater and 4 million of debt or greater. And this is not great if you're in the height of the market, especially if it's a 3 to 5 year type of window. You're right. It does take time for things to change and you can get caught in a tough situation. We do have a solution for that, by the way. Part of why I'm asking this is because we have a solution, and it's called a deferred sales trust. What's kind of unique about it is it allows you to defer capital gains taxes without having to do a 1031 exchange. As well, gives you the ability to be on the sidelines out of debt, right? Be debt free. And so we call it connecting the cash flow, tax flow, and debt flow, right? All three with a strategy that gives you what we call optimal timing, right? Which is, and what we were doing mostly in 2022 and 2021 is not buying real estate. We were lending to those who were buying real estate. And so we're in the first position, we're making about 10% and about 55% LTV. And we've been waiting for this moment, right? And we can get the money out in about 30 to 60 days, the way that we structured it. And so all tax deferred, we've been doing this, and we've been having people sell, get out of debt, get diversified, get semi 30-day liquid, not having to be tied to the big stock market, which can go crazy too, different ways, and then buy real estate at a discount, all tax deferred. And so I'm curious, from someone like yourself who's been in real estate a long time, when you hear that, like, have you ever heard of that before? And then B, what are your thoughts when you hear something like that?
So actually, no, I haven't heard of it. I'm somewhat familiar with a Delaware statutory trust, but never really heard of what you're referring to. But it's certainly something I'd like to learn about. I think we all want to learn how to save more in tax dollars. The first key is making money, but then the second key is keeping it. So the more that you're able to keep in your pocket after you actually make it, the better off we all are.
Yeah, absolutely. Tax flow is keeping it, right? I think that's a good way to put it. Tax flow is keeping it. And really quick, if people are curious about what the Delaware Statutory Trust is, it's another form of a 1031 exchange where you can 1031 into sometimes like a mini syndication, or it can be a single property too. But it's a third party, typically a big corporation. You have no control, no liquidity, no diversification. We do those still, by the way. We actually do those for debt over basis challenges, Charles, when people have too much debt over their adjusted basis, and that can be taxed as ordinary income tax. So we still use those at times. In fact, we have a program called the Best 1031 Exit Plan, which gives you the option to do a deferred sales trust, a regular 1031, and a Delaware statutory trust. And that's so valuable because people want the opportunity to buy something, but they don't want to be forced to be able to have to do it. Or they want the opportunity to diversify with some different strategies in which you can do that with the Best 1031 Exit Plan. But yeah, any thoughts on also the other part of this too? I think it might be interesting, Charles, get your take on it. Is we've helped people exit crypto businesses, in other words, things that were not like kind, and go into other real estate funds and syndications with the capital, all tax deferred. So it's kind of like being able to 1031 crypto, or kind of like being able to 1031 a business sale into a real estate fund or syndication without doing the tick structure or any of the carve outs, just coming in as a single investor. Have you ever considered what that would do for folks if you could do that?
It sounds a lot more attractive. The greatest flaw to me with the 1031 program, and I think a lot of buyers are starting to realize this now, is that the flaw with it is that you have only a very short window of time to identify your replacement property. And oftentimes what that means is that you're usually getting a worse deal than you were in, unless you happen to be in a particular point in the market where conditions are very favorable for buyers. But from a selling standpoint, most sellers know that if you're dealing with a 1031 buyer, one, they have the funds, but two, they also have a very limited timeline to identify that property. So many times they're getting the highest prices from a 1031 person. And what that also means is that the 1031 buyer is usually getting a lower return. So if the sole purpose of the exchange for them is to go out there and to defer the taxes, then I think it's successful in that regard. But a lot of times, if they want a good investment as well, aside from just deferring the taxes, most times they're sacrificing that with the 1031 exchange.
Absolutely. If people want to learn more about all of what the alternative, we call it the Netflix version versus the old Blockbuster 1031, you can go to capitalgainstaxsolutions.com, capitalgainstaxsolutions.com. We also came out with a brand new book with Kevin Harrington from Shark Tank in the book, which is pretty cool. It's called Building a Capital Gains Tax Exit Plan, hit #1 bestseller on Amazon in a couple categories. And we call it the proven playbook for unlocking your ideal wealth plan when selling any asset of any kind. Don't get caught on too much debt and overpaying for a property because of the capital gains tax in a 1031. Use the deferred sales trust, consider it, and or get the best 1031 exit plan by going to experttaxsecrets.com, which gives you the ability to do one or both and not force you into either or. And that's the best 1031 exit plan by going to experttaxsecrets.com. That being said, Charles, are you ready for the lightning round?
Yes, absolutely.
All right. Knowing what you know now, if you could go back to your 20-year-old self, what's the one golden nugget you'd make sure to tell yourself to do?
Start sooner. It took me about 12 years to really talk myself into it. When I was 20 years old and I started working for that commercial real estate investor, there was a lot of knowledge that I gained in the first 5 years. And my goal was to be out of there in 2 to 3 years. But sometimes as life happens, you stay somewhere longer than you expect to. So it took me until about the age of 32 to realize, okay, when I first started here, I wanted to do my own thing, and maybe it's time for me to go out there and do it. So start sooner. You're going to make mistakes. You're going to have hiccups. Realize that those are part of the process. Learn from them, and then just adjust and learn and move on.
Fantastic. Question number 2: what's the #1 book you've recommended or gifted the most in the past year?
In the past year, well, the two I always recommend. One is Rich Dad Poor Dad, but I'm sure that's a common one on shows like this. The second one I would always say is How to Win Friends and Influence People by Dale Carnegie. That's my personal favorite book of all time, and I think it's got a lot of common sense principles, but things that aren't always talked about as often nowadays, and they would benefit a lot of the listeners to go out there and use.
Excellent. Question number 3: what are you most curious about right now?
Where the future of the market's going to be heading.
Good. Yeah, me too. And future of interest rates, future of the market, all the above.
Right.
Next question. #1 leadership quote or theme that you strive to live by?
Can't really say that I have a quote, but in terms of a theme, my thought is always, you need to be leading by example. And I wouldn't ask somebody to do something that I'm not willing to do myself. So always be willing to take the lead and to go the furthest, and not just to tell people how something's done, but to actually show them.
Excellent. Next question. #1 way that you're using ChatGPT?
I'm not. A lot of my team members are, and one of these days I'll probably have to start doing that, but admittedly I haven't quite gotten there just yet.
All right. Next question. If you could have the one big domino that would move your team and your business forward, knocked over by the end of this year, what would it be, and how would that help you guys really to establish your goals?
Absolutely. Well, for me and my team, our biggest domino is always capital raising. So if you could raise $1 million, we could probably use $2 million. We could raise $5 million, we could need 10. So there's always a need for more capital. If we had an unlimited supply of capital available, we would find more deals that make sense and execute on more deals. The way that would help us is simply by allowing us to scale up and do more volume and just grow the company faster.
Yeah. In fact, part of a little side note here, another little plug for what we do, the ability to defer the tax and unlock the capital to flow is so important. And we think cryptocurrency is actually going to be the best opportunity for multifamily syndicators who are looking to raise capital, because a lot of folks in cryptocurrency went through the last crash and lost a lot, and now it's coming back strong. And so they're gonna want to get out, but they don't want to go into the stock market, but they have a lot of tax. Okay, and so can you bridge that gap? In fact, we did a $13.5 million exit for 2 clients. Before the crash, Bitcoin and Ethereum into the trust, which they turn around and put into business ventures, but they could easily have just turned around and put it into real estate syndications, right?
Yep.
And so it's a great way to bridge that gap. Last question for you. If after all your success, helping all the people you help, what's the best way you found to stay centered in your values, Charles, and stay encouraged to charge forward to reach new heights?
Say that one more time. You cut out.
Yeah. So what's the best way after all your success, helping all the people you've helped and building the wealth that you've built? What's the best way you stay centered in your values, but also stay charged up to reach even higher heights?
So I like to think of life similar to the way Warren Buffett does. From what I've read, I don't know Warren Buffett personally, but one thing I've always seen attributed to him is that he says every morning I wake up and I think I'm a poor man, because he said if I ever wake up and think I'm a rich man, then it's over. I lose the motivation. I don't have any desire to move forward. So I always like to think of life with that same mentality, because you want to have the same hunger, and you want to have the same level of motivation that you did when you were starting out.
Hey, I think that's cool. That's some wisdom there, baby. I love some Warren Buffett. So, Charles, I want to thank you for being on the show. We're out of time now. I want to encourage you to keep using your gifts of being a great person with people, finding deals, and helping people create and preserve wealth with multifamily syndications. For our listeners who want to get in touch with you one last time, what's the best place for them to find you?
Sure. It's going to be cashflowchamps.com.
Fantastic. And thank you, Charles. And also thank our listeners for listening to an episode of the Capital Gains Tax News podcast, or checking us out on our YouTube channel, where we're streaming live this podcast on either Expert CRE Secrets YouTube channel or the Capital Gains Tax Solutions YouTube channel. And we appreciate you watching. As a reminder, we believe most high net worth individuals and those who help them, they struggle with clarifying their capital gains tax deferral options and or finding new ways to raise and bring in capital. And we believe the deferred sales trust is one of the best ways to solve both of those challenges, as it works with the tax flow and cash flow and debt flow that we talked about today. As a solution for that, to learn more about how to do that, you can go to capitalgainstaxsolutions.com. Again, you can check out the book, Building a Capital Gains Tax Exit Plan, on Amazon. And or if you want the best 1031 exit plan for your next 1031, because friends don't let friends 1031 without having a backup plan. You want to make sure you go to experttaxsecrets.com to get started with that today. Thank you so much for listening or watching. Please rate, review, subscribe.